You finally have a large pile of cash to invest. A bonus, an inheritance, a business sale, or years of savings. The questions sound simple. Put it all in now, or spread it out slowly. This is the choice between lump sum investing and dollar cost averaging. Both can be reasonable. Both can feel scary. And the best answer is not only about math. It is also about regret, behavior, and whether you can actually stick with the plan. Lump sum investing means you invest the whole amount at once. Dollar cost averaging means you split the amount into smaller pieces and invest those pieces on a schedule. For example, investing $120,000 today versus investing $10,000 a month for 1 year. Many people already dollar cost average without using the term. If money goes from every paycheck into a retirement account, that is a form of scheduled investing. You are buying regularly, whether the market is up, down, calm, or chaotic. But a paycheck plan is not the same problem as a sudden cash pile. With every paycheck, the money arrives gradually. With a bonus or inheritance, the money is already sitting there. Now, the real question is what to do with cash that is available today. The decision matters because markets move while you wait. If the market rises after you invest, the lump sum looks smart. If the market falls right after you invest, dollar cost averaging feels like protection. The catch is that nobody knows the next move in advance. At the heart of this debate is a trade-off. Lump sum investing gives your money more time in the market. Dollar cost averaging gives you more time before all your money is exposed to market risk. One favors expected growth, the other softens the emotional landing. Historically, diversified markets have tended to rise more often than they fall over long periods. That does not mean they always rise. It means that waiting in cash usually has a cost. If the market goes up while you are easing in, the uninvested cash misses those gains. This is why lump sum investing often has a mathematical edge. It puts the full amount to work immediately. If the money is meant for a long-term goal, like retirement many years away, every month spent waiting is a month with less of the portfolio participating. The problem is that math does not feel the pain of a bad entry point. Imagine investing everything on Monday, then seeing the market drop on Friday. Even if the long-term plan still makes sense, the emotional hit can be intense. That feeling is called regret risk. It is the fear of looking back and thinking, why did I invest all at once? Dollar cost averaging can reduce that specific regret because only part of the money is invested before any one market drop. If this kind of plain English investing explanation is useful, consider subscribing. The goal here is not to predict markets. It is to understand the decisions clearly enough that money choices feel less mysterious and less emotional. Dollar cost averaging uses a simple rule. Invest the same dollar amount at regular intervals. When prices are high, that dollar amount buys fewer shares. When prices are low, it buys more shares. The schedule does the buying instead of your emotions. Suppose you invest $500 each month into a fund. In 1 month, shares cost $50, so you buy 10 shares. In another month, shares cost $25, so you buy 20 shares. The lower price automatically gives you more units. Dollar cost averaging does not guarantee a profit. It also does not guarantee the lowest possible average price. If the market climbs steadily while you are investing, every later purchase may be more expensive than the last. In that case, lump sum would have done better. Dollar cost averaging shines emotionally when markets fall during the investment period. The first purchase may go down, but later purchases happen at lower prices. You feel less like you picked one terrible day and more like you are entering gradually. In a rising market, the opposite happens. The first piece benefits, but the cash left on the sidelines does not. Each later purchase buys at a higher price. This is the hidden cost of waiting when the market moves up faster than expected. A useful way to think about this is that cash is not neutral. Cash avoids market swings, which can be valuable in the short run. But cash also avoids market returns. Holding cash during a dollar cost averaging plan is still an active choice. Dollar cost averaging does not remove risk. It moves some of the risk into the future. Once the schedule is complete, the full amount is invested anyway. So the main benefit is the path you take to get there, not a permanent shield from losses. That path can matter a lot. A perfect strategy on paper is useless if you abandon it during a scary week. For some people, investing gradually is the difference between starting and doing nothing. Behavior can turn a slightly less efficient plan into a more realistic one. The worst option is often not lump sum or dollar cost averaging. It is having no plan at all. People say they will wait for a better time. Then the market rises, fear turns into hesitation, and the cash stays parked for months or years. Trying to wait for the perfect entry point sounds wise, but it can become market timing. You need to know when to get in and also when to stop waiting. That is much harder than it feels when the decision is still imaginary. A better approach is to decide the rule before the market tests you. If you choose lump sum, know why. If you choose dollar cost averaging, choose the schedule in advance. The plan should not change every time headlines get louder. Start with the goal for the money. Money needed soon should usually be treated differently from money meant for decades in the future. If the cash is for a house down payment, emergency fund, or tax bill, the main job may be safety, not market exposure. For long-term investing money, the question becomes asset allocation. That means deciding how much belongs in stocks, bonds, cash, or other assets. Lump sum versus dollar cost averaging is about how to enter the plan. Asset allocation is about the plan itself. This matters because a conservative allocation invested all at once may be less risky than an aggressive allocation averaged in slowly. The entry method gets attention because it feels dramatic, but the mix of investments usually drives the risk over time. Imagine someone receives a $50,000 bonus. They already have an emergency fund and no high-interest debt. The money is for retirement 30 years away. A lump sum approach would invest according to the target portfolio right away. The same person could also invest that bonus over 6 or 12 months. The monthly purchases would reduce the chance of feeling unlucky from one bad day. The trade-off is that some money sits in cash during the schedule and may miss gains. Now imagine an inheritance. The money may carry grief, family expectations, or fear of making a mistake. In that situation, a gradual plan can create breathing room. The point is not only returns, it is making a careful decision during an emotional period. Some people use a hybrid. They invest part of the money immediately and average the rest over time. This can be a practical compromise. It gives some money more time in the market while reducing the regret of putting every dollar in on one day. If you dollar cost average, keep the schedule simple. 3 months, 6 months, or 12 months can be easier to follow than a complicated rule. The longer the schedule, the longer cash stays outside the market. The shorter the schedule, the closer it feels to lump sum. A common mistake is calling it dollar cost averaging, but secretly changing the schedule based on headlines. If you pause every time the market drops, the plan becomes timing again. The strength of dollar cost averaging is that the rule keeps operating when feelings change. Practical details matter too. Trading fees, fund minimums, taxes, and account rules can affect the best process. In many modern accounts, recurring purchases are easy. Still, the mechanics should be checked before setting a plan, especially for taxable accounts or unusual assets. Automation can remove a lot of friction. If the plan is to invest on the first of each month, setting up automatic transfers can prevent second guessing. The fewer decisions you have to remake, the less room there is for fear to take over. So which is better? If we focus only on long-term expected returns, lump sum often has the edge because markets have generally rewarded time invested. If we focus on emotional comfort and regret management, dollar cost averaging can be easier to live with. The real test is not which strategy sounds smartest in a spreadsheet, It is which strategy you can follow through a bad headline, a red week, and a moment of doubt. A good investing plan should be financially sensible and psychologically durable. Here is a simple framework. First, separate money needed soon from money meant for the long term. Second, choose an asset allocation you can tolerate. Third, decide whether immediate investing or a fixed averaging schedule helps you stick with that allocation. Lump sum and dollar cost averaging are not enemies. They are tools for different problems. Lump sum answers the question of how to maximize time in the market. Dollar cost averaging answers the question of how to enter the market without letting regret control the decision. If you were sitting on a large cash pile, which approach would feel easier to stick with? Lump sum, dollar cost averaging, or a mix of both? Leave a comment with your question and suggest the next money topic you want explained.